go. Hello, everybody, and welcome to our real estate investor workshop. Today, we'll be discussing how to raise capital and find off-market deals with special guest Tony Marinov. My name is Michael Matthew. I've been a professional accountant for more than 30 years. My international practice is increasingly focused on real estate and real estate investors. I'm also the CFO for a local home builder. I own a condo in the Toronto area, and I'm looking for small apartments in the US, currently looking at Houston, Texas. In terms of services, I offer entity structuring, which is setting up your corporations, both in Canada and the US, and operational and tax consulting and planning. In addition, I provide tax return preparation for both Canadian and US returns. So before we get started with Tony, just a brief disclaimer to keep my lawyer happy. None of the information provided in this presentation or provided through this presentation is given as tax, accounting, or legal advice. It shall not be relied upon as such. None of the materials are to be construed as a solicitation, recommendation, or offer to buy or sell any security, product, property, or instrument. And while I do my best to ensure the information is up to date, it's always possible that a new law will pass tomorrow or a significant court case will come out tomorrow, changing the rules. So please, before undertaking any real estate investment, do check with your advisor. We'll have a Q&A period at the end of the presentation. And for now, please put your questions in the chat so you don't forget them. If you have more detailed questions or have something you'd like to discuss one-on-one, please email me at the address you see, which is michael@mmcpaca.com, to arrange a mutually convenient time. Our next event will be August 25th, starting at the same time, 7 p.m. Eastern, and our topic will be announced later. So please grab a pen and paper or open a document on your computer so you can take good notes. Tony Marinov has been involved in the real estate industry for many years, first in construction and later in buying real estate, primarily in British Columbia and Ontario. His current focus is showing people how to make double-digit returns backed by real estate, as well as showing them how he is closing off-market deals with no down payment on his part. So with that, Tony, why don't you start sharing your screen so we can see your slides?
Hi everyone, how you doing? Thank you for the introduction, Michael. So I'm going to share my screen here. 1 second. So yeah, my name's Tony, and for those of you who don't know me, I have been involved in real estate investing and construction for over 20 years. And today I'm going to talk about how I made $369,000 in equity gains and closed with no down payment in the last quarter in Q2. So that's in 3 months. All of these deals that I'm going to talk about today were off market. So they were not found on the MLS. They were private sellers who wanted to not go through the trouble of selling on the MLS with the realtor. I'm going to talk about who I am, how we bought these properties, a little case study of one we did that we bought for $730 and today it's worth $1.5 million. Our process for finding deals and my new strategy going forward since the rate hikes. So this is me. I'm standing outside a 20-unit apartment or a 30-unit apartment building in Scarborough that 20 years ago, 2 decades ago, we owned this property. We bought it remotely, we managed it remotely, and we sold it. And we were in real estate doing active deals. We would buy a deal and we would sell it, whether we were tearing down houses, doing renovations, buying apartment multifamily buildings. We treated them all as active deals. And now that information's become available and we've learned a lot more, we've learned that we should have kept all of our assets and refinance them over time. So going forward, our plan is to acquire as many of these properties as possible and cash flow them for the long term. For a little example, this building, when we bought it, was around $1 million, and we sold it a year later to make a little bit of profit. Today, this building is probably around $9 million. They're trading at, this is in Scarborough, Ontario. So, doors are trading at about 300 grand a door times 30 doors. So over the years, I've been into surfing, snowmobiling. I was a sailboat captain for a number of years in the Caribbean. I got to sail all of Europe, Africa, the Caribbean islands, the South Pacific. These are some examples of some jobs or deals that we did in the past. So this is a 160 unit apartment building that we were hired to renovate all of the units in the building, and it was a full building envelope repair, and we were hired as general contractor to do that. On this one here, this low rise you see is where we were hired to do a renovation on 77 units, I believe. That would included removing the balconies, replacing the windows. So a large scale multifamily renovation. This house and this house you see here are just two examples of the dozens of homes that where we've torn down an old house, built a new house, and then sold it. Looking back in hindsight, if we had just kept these houses, put basement suite units in them, and rented them out, we would have been building an asset portfolio for the long term. And I'd have, dozens of homes on the west side of Vancouver in my portfolio. And that's partly how came up with the strategy going forward, is looking back and realizing what we could have done. So this here is I forget how many units it is, but when I was 16 years old, I decided that I wasn't going to let school get in the way of my education. School wasn't for me. I dropped out of high school and I went directly to work on, this is the building I ended up working on, swinging a hammer as a laborer and, getting into carpentry later on and that sort of thing. But when I was on these job sites, I was looking around and I realized that I wanted to be involved in real estate investing, and not so much, I wanted to be involved in the business side of it. So around that time, I was certainly rebellious and I got into a lot of trouble. And that trouble followed me into my late 20s. And once I put that trouble behind me, I got back into the real estate and we're pressing forward. So this is an example of a deal that at the time we thought we overpaid for it, and we bought it in a really hot market when things were just going up and up and up, and you couldn't really negotiate. But that was 3 years ago, and our purchase price at that time was $730,000. And today I have an appraisal back at 1.5 million. So in a short 3-year period of time, we were able to create over double the value in this property and create a large equity position. And so what this is it's a 3-level home. The top floor is a 3-bedroom, 2-bath. The main floor is a 2-bedroom, how would I say this, self-contained unit. And then there's also a bachelor unit as well. So there's 3 units on those 2 floors, and we're in the process of now putting 2 more suites on this basement floor. So once we're done with those 2 suites on the basement floor, The plan is to rent them out. Okay, so upstairs is rented at 3,300 currently. On the main floor, the 2-bedroom unit could be rented for 1,700 a month. And then we're gonna have 3 micro suites, all renting at their micro suites are basically bachelor units. So those bachelor units will be renting at 1,600 per month. So the grand total, and this is just market rents. We're not even looking at in this analysis, we're not looking at the Airbnb potential, which is on a whole different level. So a grand total income of $9,800 per month. That gives us an NOI up around 98 grand a year. So to get to this point where we're cash flowing like that, we bought for 730. We're investing 200,000 into renovations to suite the micro suites in the basement, and we have an after renovation appraisal of 1.5 million. So that's just a case study of a deal that we did that took us 2 to 3 years to build equity in the deal. But the next deals I'm going to talk about are much higher velocity. And the reason for that is, like, we're able to do in some of these deals in 3-4 months what it took us to do in 3-4 years in terms of forcing the appreciation. And it's because we're finding them so under the appraised value. Like when you're finding off-market sellers, and my big key takeaway or point here is when you're dealing with people who don't sell their properties on MLS, and you can find people who genuinely need help and you're able to solve their problems, you can get all of the properties we closed on in the last 3 months have been between 14 and 37% below the appraised value. And I'll explain why that's, and that's the look on my face every time my team notifies me that we got another deal in the door. So, you know, I'm going to talk about how we find these deals in the US, and then I'll segue into Canada. But down in the US, there's a tool called PropStream. And what PropStream does is gives us a list of addresses. We can filter areas by houses under $300,000 that are owned by vacant or absentee owners, out of state, vacant. So it'll be a vacant house that has an absentee owner that lives out of state. And those metrics tell us that the person has multiple homes, they're far away, they're probably not that invested in the property, and it's probably a liability for them. And a lot of times people inherit these homes and, you know, they're sitting vacant and costing these people money. So once we have that list of addresses in an area we're targeting from PropStream, we upload that to Batch Leads, which is a skip tracing service. And what Batch Leads does is takes different points of data from the internet and gives us those sellers' phone numbers. So then we take that list of phone numbers and we upload it to Mojo. Mojo is a 3-line dialer. So it helps us get through, like if we have a list of 12,000 phone numbers, when we put it into Mojo, what Mojo does is it'll dial three phone numbers at a time, and whoever answers first is who it cuts off the other two callers. So it helps you get through a bigger list of people faster. And then, you know, when I first started, I was on the phones taking all the calls, but it got to the point where we're generating so many leads that I had to outsource the sales part of managing potential leads. And where I found the most luck with that is hiring salespeople who live in foreign countries as expats. So you can find Americans, Canadians, and that sort of thing living in Brazil and Colombia and these other countries, Bali, and hire them for a lower rate than you would be able to get them for if they lived in the US, because their cost of living is so much lower down there. So that's how we're connecting with these off-market sellers. And this is actually a deal that we did in Tennessee where the house was sitting vacant for 10 years. The owners had, it was three siblings who had inherited it from, like an estate sale. It was an inheritance, and there was three owners on title. And when I got in touch with the executor, she told me that one of the brothers was a half brother and he was estranged and they couldn't find out where he is. So they would have needed him to sell this property. And so I did the work. I went and tracked him down. I found him. I got him on board and I coordinated getting the paperwork in front of all of them so they could sign. And so that was a reason. This was a great deal. It was a nice house in a nice neighborhood, but they couldn't put it on MLS with a realtor because between the three of them, they just couldn't get themselves coordinated. So that's where us as investors, if we can get in there and figure out what the problem is and solve that problem, which in this case, it was that they just couldn't get on the same page. That's how we make the money in these deals. Otherwise, like this property would have just been put on MLS or sold with a realtor at $75,000. If I remember correctly, we either picked it up for $30,000 or $40,000, somewhere around there. But what I do remember is we sold it for $75,000 before we even closed on it. So what that means is we were able to sell the property before even closing on it, take a $30,000 or $40,000 wholesale fee and an acquisition fee and or assignment fee and on to the next deal. So when we're generating off-market leads, it's for wholesale purpose. But since the interest rate hikes, it's become harder to do. There's not as many buyers out there. And that's why we're transitioning into a new strategy, which is the BRRRR method. BRRR, buy, renovate, rent, refinance, and repeat. 4 R's. I never know how many R's it is. 4, yeah, okay. So a little more of the same. So we run a similar type of marketing in Ontario, and I chose Ontario because I'm from Canada. I have a presence in Ontario. We have the teams in place to execute on renovations and that sort of thing. And so it just made more sense than going down to the US and getting set up there. So this one is in Brantford, Ontario. It is a single family home, 1,200 square feet above ground finish and 1,000 square feet finished in the basement. Brantford, Ontario is a town of about 120,000, 20 minutes away from Hamilton, and Hamilton is part of the GTA, which is a strong economy with a lot of jobs, a lot of immigration. And currently, actually, the guy we're renting this unit, the front unit on, he commutes to Hamilton every day for work. So this is a commuter city for Hamilton. So this seller, this was an off-market deal. And when the seller phoned us, he was in a panic and he was in a rush, and he just said, "Hey, I need a quick closing. I need to close. I'll sell to you guys, but I need to close in 3 weeks." His story was he had bought a property in Costa Rica and he had put I think it was a $60,000 deposit on a property in Costa Rica. And if he wasn't able to sell his home in Brantford, he would have defaulted on the deal down there and lost his 60,000. So that was a huge motivating factor for this guy. And on top of it, it needed a new roof. It was in good condition, but there was just a few little things it needed. And for him to fix the roof, paint the house, clear out all his stuff, that would have taken a month or two. Then if he put it on MLS, it would have taken a month or two to sell on MLS. So he was looking at 2, 3, 4 months to be able to sell it the conventional way. So in his head, he was willing to take a lower price to get a fast sale. And that's where we were able to solve a problem for him. And on top of it, he was out of money, and I've done 2 deals this year like this where they asked for $10,000 loans up front, and it's always for the same reason. It's because people have too much stuff. The guy asked for a $10,000 loan so he could get a storage container and start moving his stuff into the container. This is the second deal this year that I've gotten where the seller has asked for an upfront loan. So I gave him $10,000 cash on a promissory note, and which is not the most secured form of lending, and later in the deal, I had a lot of people like push back on that. My insurance agents, my mortgage brokers asking me, why would you lend this guy $10,000 cash? Are you crazy? Like, and my answer to that is we got the property. So the price we bought it at, it's on this slide here. The price we bought it for was $750,000. Now, the appraised value of the property at that moment, without doing anything to it, was $868,000. That means it was $118,000 below the appraised value. Now, with that, that means we're making money right on the buy. We're making $118,000 by buying the property. And on top of it, this is where a lot of people have it in their head that when they go to a mortgage broker, they have to come up with a down payment and all this. Like, if you're able to find the right deals and you find them like this, significantly under market value, what we did in this case was we took it to the mortgage broker, and the mortgage broker gave us 100% financing. Okay. What that means is no down payment. Now, that's a big change from back in the day when we used to go looking on MLS and we would buy a property that's full price and it's the same as the appraised value. Now the lenders are, giving us properties with no down payment or giving us financing on 100% financing. When the appraiser was there, I asked her, hey, if I fix the roof, I put a new paint job on the inside, and I put a kitchen in the basement, because when I was there, I noticed the basement had everything, like a bathroom, a second separate entrance, and if it just had a kitchen in it, it would be a separate self-contained unit. So she said if I finish those 3 things, she'll give me a $960,000 appraisal value. So what we did was we closed at $750,000 purchase price, 100% financed by private lenders. And this is another thing that people need to unplug from, is this, to do creative deals like this. One is how you're finding them. So you got to get creative at finding them off market, whether it's through Kijiji, Craigslist, and that sort of thing. But then to close them with no down payment, I know a lot of people, I see them just fishing for the lowest interest rate. And that's all they focus on, is like, how can I get 3% or 4%? But in this case, I'm paying 10% interest, but I was able to get 100% financing. And I'll show you why I'm happy to pay 10% interest. Anyways, and I'll get to that at the bottom. But so we purchased for $750,000 and did a 20-day renovation. The appraiser came back 20 days later and gave us an as complete appraisal of $960,000. So we created $210,000 of equity in this deal in 20 days. Scrolling down. Okay, so this right here is the kicker in this deal. And the reason why I was comfortable closing with 10% interest rate on my money. So my intention is not to flip this property. My intention is to actually flip it to myself and keep it for the long term. So It has a shop. I don't know if like anyone knows this, but Ontario just came out with a province-wide rule that all properties that have, somehow they're all allowed to do auxiliary dwelling units or coach houses because they're moving to densify, because there's not enough housing, not enough supply to keep up with the demand. And turns out that not all of the municipalities have caught up to the provincial rule, but turns out that this property is in Brantford and it's one of the municipalities that's spearheading this movement towards coach houses or auxiliary dwelling units. So this one is zoned for believe it's a 600 or a 900 square foot coach house. And this is the blueprint of the coach house that we're building in the back. Now that we've completed that phase 1 renovation and we have built 210 grand of equity into this property, we're able to go back to our lenders based on the equity in the property and get 100% financing to build this auxiliary dwelling unit in the back. And what we have here is something we got from Bruce Firestone. I don't know if anyone knows him, but it's basically a 2-bedroom unit. You can see on one side here you have, where are we? On one side here you have the kitchen, you have the living room, you have a bedroom with a washroom. And then if you notice this door here, if you go into this side, that's another bedroom. It's basically a bachelor unit and it has a wet bar here. So if that door was closed, this can be rented separately on Airbnb. For somebody coming to stay on Airbnb for a night, you know, it's a good size. It might not be great for long-term living, but this can be run as one full unit or 2 separate independent units by closing this door. And because of this income potential from this coach house in the back, once we're done the renovations, even if I sat with 10% interest rate money or a loan at 10% interest on this whole project, it would still break even. So I would be able to hold it for a long period of time. This is the level of finishes that the house has in it, by the way. So like, and this is before we even did any renovations. So it's possible to find deals on properties that are in good condition. You don't have to buy a junker. They're out there. The deals are out there. You just have to know how to surface them. So right now in phase 1, I have upstairs rented at 2,400, but I have it rented out at 2,500, but we ran the numbers at 2,400. The basement unit could be rented for 1,600, and the shop in the back, without renovating it, could be rented out at 900 a month, just for like as a shop, not as a living space. Now, after we complete phase 2, which is the building of the coach house in the back, this is how the rental numbers will look. So we got 1,900 on the sheet here. This is what we put down, but I've already exceeded this. We're renting this unit for 2,500 a month. So these numbers are on the very conservative side. 1,900 for the 2-bedroom, 1-bath upstairs, 1,600 for the basement suite, 1,600 for the flex unit in the main house. So these are 3 units in the main house. And then in the coach house or the auxiliary dwelling unit, the guy who gave me that blueprint has his rented out for $1,600 per side per month. So these are pretty conservative numbers, and that brings a grand total income of $8,300 per month. And I plugged the numbers in as if we had a 30-year amortization and a 6% cap rate or a 6% interest rate. after we refinance in a year. So this property will generate a free cash flow monthly after all expenses, after mortgage payment and everything, $1,700 per month. And that's a cash on cash return of 9.52. So there's a little bit more like details in here, but so I'm just gonna point out, I know these numbers are blurry and stuff. It's even hard for me to read when we're on this call. But when I ran these numbers, and I can send out a copy of this, we had the after renovation value after we do phase 2 construction at 1.1 million. But my appraiser just came back with the appraisal today and it came out to 1.4 million. So when we ran these numbers, this is what it looked like before we got the new appraisal back. So as you can see on the active appreciation side, this is a little graph that shows the return on investment in this property. So on the active appreciation, so there's 4 profit centers, by the way, in a deal, right? One is active appreciation, and that's the appreciation we force through strategic renovations. There's the passive appreciation, principal recapture, and that's as the tenants are paying your mortgage, as the tenants are paying rent every month, you're taking that, paying towards your mortgage, and they're actually paying a portion of your mortgage down for you. So 13,000 in principal recapture and 20,500 in free cash flow. So if we combined, and by the way, I have 250 for active appreciation. That now that we got the new appraisal back today, this number is actually doubled. So this deal looks even better than when we made the projections. If you combine all of those ROIs together, all of those return on investments, that's a $364,000 return on investment in 1 year that we're able to create. So the first deal I showed everybody, we were able to do this kind of, forced appreciation or appreciation over a 2 to 3 year period. But this is an example of one that we're going to get done in under a year. And a big part of it, a big reason why we're able to do these kind of deals with no down payment and force appreciation so rapidly is because we're finding them off market and under the appraised value. So that's a really big key in executing on a strategy like this. Does anybody have any questions? Are you good if I read some questions, Michael?
Sure, that's fine.
Okay, before I go on to the next deal, does anybody have any questions about this? No. I guess we're explaining so well that nobody has any questions.
That must be it.
Right. Okay, so yeah, and the strategy here is to hold the property for 1 to 5 years and reassess in 5 years. We'll just run it and keep it for cash flow for the next 5 years and see what happens, if it makes sense to sell it in 5 years or refinance it.
I have a quick question. Can you hear me?
Yeah. Hi, Philip.
Yeah, hi. So you say you was able to get 100% finance privately, right?
Yes, sir.
So normally they want to like leave some room in the budget for in terms of the LTV. So what process you had to show, or how did you convince the lender to go all in with you putting no money down? Because that's the tricky part. How did you convince the lender to go all in?
Right. Great question. Great question, Philip. So my purchase price was $750 and I got 100% of $750 from them. But my purchase price was $118,000 below the appraised value. So when the appraiser comes to the property, when she came to the property, she said this property is worth 868,000. So that brought us to, I think about 15% equity, like that $118,000 below appraised value is about 15% equity, and that was basically our down payment was in the
Oh, okay, I see. Because so the worst case scenario, if you default, they had enough skin on the property to sell it back to get a profit. So technically, that's the money you put up
That's
in
right.
in the equity. So that's the trick, to have enough room on the buy to do creative financing. I mean, in terms of no money out of your pocket.
Right.
Well, they
And
only had $10,000 in the deal, basically.
I had zero, like just my legal fees up front, like really like
No,
1,000.
you said they gave the guy $10,000 up front
Oh,
as a loan, right?
equity in the deal.
Yeah.
No, I think he's referring to the guy that needed it for a storage bin.
Right, but when they gave us 750, he paid me back.
Oh, okay. So technically, it's all in the wash. Oh, okay.
Exactly, and we made interest.
He paid interest. That's a good
Well,
part. That's a
a
good
little
part.
bit, little bit. So,
Okay.
It's a
so
loan.
exactly right. I did the other one. I did. There was no interest, so it just depends on the situation. But yeah, it was a wash when we got 750 to close. That 10,000 came back to us, but we could have registered a second mortgage on the property, but we didn't even bother. We did it as a promissory note. So it was a risk that a lot of people are not willing to take, but it's worked for us many times now.
I mean, even if you lost your $10,000, you're still 100,000 up anyway. So
Well, exactly.
Yeah.
And he had a property that I could go and I knew he had the assets that I didn't think he was gonna mess around over 10,000,
Yeah, that makes sense.
Yeah.
All right.
So, but and then another key thing there though is
Yeah.
you have to have the right, this was through a mortgage broker, not like even private people. So you have to have the right mortgage broker who can understand this stuff, and you might have to shop around for different mortgage brokers, and like you have to be willing to pay 10% money. But for me, it's like this. If I got 5% or 6, what is it with the B lender right now? 6%, I think.
100% financing.
No, like if you go to a B, what is it with a bank right now? Is it 5%?
Well, with the banks, if you go in traditional,
Yeah.
they want to go no more than 80 LTV, and if you go on a fixed, they're in the mid 6 right now. If you go on a variable,
Yeah.
they're, because of the 1% rate hike, they're up to high 4s, so close to 5s right now. But you got to qualify at 5.25 plus 2, or the prime rate plus 2%, whichever one is higher.
Right. Yeah. So I see a lot of people focusing on the interest rate, and my point is like, even if I got this property at a 5% interest rate, right? My monthly payment on that 750. So right now I got it at 10%, and my monthly payment is 6,200 per month. So per month my payment is 6,000, whereas if I went the traditional route, it would have been about half. But
You would have to have 20% up.
right. But so what I'm doing is I'm just making up for it by putting lots of suites in the house. Like how do you make up for that extra interest rate? Well, just build more units,
One more question. Is that a interest only loan, or that's a mix with principal and interest?
Interest only.
The feeling. Okay.
But okay, so when you go traditional, banks start to look at you like they're assessing you, how many properties you have, and they don't actually like to do multiple properties. It gets to the point where they're looking at you like a risk. But when you go to the private side and you're willing to pay 10% and you know it doesn't matter because you can cash flow, my lender, we gave him a package of, your, like, you fill out their paperwork. We did that 3 years ago, and he hasn't asked us for anything, like doesn't even check our credit. We just bring him the appraisal because he knows us now and we have that relationship. But it gets to the point where you can just bring them the appraisal, and if the deal looks good, 100% financing. There's no qualifying. There's none of this, like,
Yeah, gotta land on the equity of the property.
exactly. So, if it cash flows, if it can service the debt, and you don't have to like qualify, like the deal is the qualification, you can have unlimited amount of deals. So now it becomes a lead generation. Like, how many of these can you generate? Because they're not costing you anything to do. I mean, I say they don't cost anything, but you always end up putting a little bit of your own money in. It costs money, even if they're giving you 100% financing.
Yeah.
Any questions? Any more about this one before I go on to the next one? We're good? Okay. So this is another deal. We just closed on this 2 days ago or 3 days ago, and my team member Gabrielle just picked up the keys to the property. I remember this one when we had it under contract. We get properties under contract before we even see them in person. We get the seller to send us pictures and we pull comparables, and then if we get it under contract, then we go out there, because it's not worth our time unless we know it's a deal, right? So this one, we got it under contract, and I was living in Brantford managing the first phase of construction at that other one. And this was out by Windsor. It's in a great town. I'll show you the map first. So this is the location. I don't know if it's down in Essex, close to Leamington, 30 minutes from Windsor. But when I got on the street, I was shocked. These are like, on this side, there's some $1 million homes, 800,000. Down here on the water, certainly above $1 million, like beautiful neighborhood. But when we had this one under contract, I already had it in my head, like something's wrong with it. There's no way that this is a deal. I thought like this, I had it already written off on my drive out there. I'm driving there from Brantford, 2-3 hours, and thinking in my head, like the house is probably a tear down. And I know in this area, I can get a lot, like a building lot for 150. So I was like, we have this thing under contract for 260, and it's probably not even worth the dirt that it sits on. It's going to cost me 40 grand just to remove the house. And I already, but then when I got there, oh my God, I turned down the street, I see the neighborhood, and I'm like, holy crap, what a nice neighborhood. And then I get to the house and it's like almost perfect condition, like nothing, solid house that like we could sell it on MLS tomorrow, no problem. I'm like, wow, this is insane. So this situation was the guy, same thing. He bought a property in Manitoba. He was moving to Manitoba. And if this didn't close, he would have not been able to close on the other property and lost his money over there. And he had 3 big dogs and he had a 1-year-old child, and the house was full of stuff. Like he had been living there since 15 years. So again, he didn't want it listed on MLS, didn't want to have people walking through, like 3 big dogs, a little baby, all this pressure. So we made him, an easy offer, no showings, one walkthrough. We said, well, we'll make you this offer and we'll come do 1 walkthrough. So I went there and it turned out great. As soon as I saw it, I ordered the appraisal, and the as-is appraisal came down to $410,000 as is, with no renovations, nothing. And the beautiful part of this property is it's also zoned for a coach house or an auxiliary dwelling unit. So given that the appraisal was 410, our purchase price was 260, that's a built-in equity or below appraised value of $150,000, which represents 36.5% equity on the buy. So we made 150,000 just by buying this property. Now, this one is actually a really interesting one, because just today I opened my bank account and there's $100,000 in the bank. We got 306. The bank, our lenders gave us our purchase price was 260, but they gave us 360. We got paid $100,000 to close on this property. So I know it says July 31st, but we ended up closing sooner. This is the location. And again, we plan to now build the coach house in the back. And when I have the coach house done, in the last one I showed you guys, we're going to have 5 units. But in this one, I think we're only going to get 4. So this is what the rental income could be: 1,800 upstairs, and then 1,600 basement, 1,600 in C1, and 1,600 C2. Purchase price 260. Renovations, cost to build the coach house and do a little bit in the house is about 300,000. And the after renovation, I'm working on getting an appraisal for the after renovation value. The one in Brantford came back based on a cap rate. The one in Brantford came back to 1.4 million. So if we do this one on a cap rate, I think that, which I'm in the process of doing, I'm pretty sure we're going to get closer to 1.1 million. But I ran the numbers very conservatively. If we were to refinance this with a 6% mortgage rate, interest rate, it would give us a free cash flow after construction, after all expenses, of $1,538, and then a cash on cash return of 5.85%. And if we scroll down to look at the 4 profit centers in this deal, this shows, one sec here. Where is it? It's hard to see everything on one. Anyways, on the active appreciation side, there's about $290,000 of forced appreciation that we're making through strategic renovations. You know, passive appreciation could be 60 grand if it appreciated at 7%, which historically most of Ontario has. If you look at the 50-year graph, I know right now things are kind of up in the air, but when things get back to normal, that's 60 grand a year. Principal recapture when the tenants are paying down the mortgage, 10,000, and free cash flow, 18,000. Now, if we combine all of those profit centers into a total ROI, that's 378,000 in 1 year. I think less, probably in about 8 months, for total ROI. And here it says 119% ROI, but because we are going to have $0 into this deal, and I mean like 0, we didn't pay land transfer tax, like everything was covered by the lender. This is actually going to be infinite ROI. So that's another example of getting paid to close on a property if you have a good deal. Should I open it up again, Michael? Do you mind if I take some questions if anyone has any?
No, that's fine.
Okay. Does anybody have any questions or thoughts?
I
Yeah.
have a question. Oh, sorry. Go ahead.
Okay, yeah, I'm just wondering, how do you find these deals? What's do you? I don't want you, maybe you don't want to give up your secrets, but just what's your funnel? How do you?
Absolutely. You know what? There's 7 million homes in Ontario, so I'm happy to share, and I hope you get 100 deals this year, so I'm happy to share. It's not like there's enough homes to go around for everybody. So when I started here, I talked about PropStream, Batch Leads, Mojo. This is the process we use in the US, and it's a little bit different in Canada. But basically, we're spending money on marketing every month. We send out yellow letters in the mail. We put up my best deal, which is not here. I have one that's even better than this, where I got 230,000 below purchase price. It came from a bandit sign. Are you familiar with a bandit sign?
Yeah.
Yeah. Bandit
Weekends.
What's that?
You put them on the weekends, I guess.
Yes, sir. That's right. So the bandit sign one, I train MMA, and I was driving to the gym every day, and I saw all these houses that were like nice neighborhood, but really, really ugly houses. And so I went and put bandit just on the way to the gym, like not even thinking about it. Just, oh, I'll put it up. Who cares? Forgot about it. And sure enough, a week later, the phone rings, and the guy that calls me has a really distressed situation. And I got that one for 545, and the appraisal was 770. So everything, my advice is learn how to wholesale, like Google wholesaling or on YouTube, and everything they do in lead generation for wholesaling. That's how we find our off-market deals.
Okay. All right. Yeah, and you mentioned, yeah, because that's why I asked the question. I know in the US, there are lots of apps, websites, and stuff that even for wholesaling that makes this easy. But for Canada, it's a bit hard to find these tools to use. So thank you for letting me in on your secret.
Yeah, I recognize that, and that's why like we got started wholesaling in the US, and that's why I kind of like suggest people who want to like learn the easiest way to remotely do it is in the US. But then once you learn the whole, like everything, like because there's also an element of like selling, like sales with the sellers. Once you get like a few deals under your belt, and you want to try it in Canada, and I wouldn't recommend this right away, but then it makes money to spend. Then it makes sense to spend money on Google ads, SEO for a website, Facebook market, like actually spending money on advertising.
Mm-hmm. Yeah.
But the easiest and cheapest way to learn the marketing is in the US, 100%.
All right. Thank you.
Yeah, no worries. Anybody else? Philip, did you have a question?
Yes. So I don't know if I'm going to be jumping the gun or you're going to talk about it at the end, but yeah, you keep running your numbers at like 6% and all those interest rate. My question is, you said that where are you refinancing these deals, with a B lender or are you going back A?
Yeah, if I can find a JV partner, and by the way, if like we're always looking to partner with people on joint ventures. If I can find, I don't qualify. I'm a flipper. Like I have my income. I don't have T4 income, so the A banks don't like me. There's no way I'll get conventional financing. So my strategy is if we have to do it on our own, we'll do it with a B lender. And I've still talked to B lenders that have 6.5%. But if I could get a JV partner who can get traditional financing, I would go for that for sure.
But you said earlier, you said the A lenders kind of have a cap on the amount of rental income the properties they want, because after a certain amount it's called considered high risk. So I guess your JV partner is going to be, he will be like the main applicant on that mortgage.
That's right.
So, okay, I see what it is.
He would probably be only on the mortgage. You would not see me on title anywhere. I would have a separate trust agreement with them that's not registered anywhere, because as soon as I go on title, then they want to see my income, my credit, and like I will bring the deal down. Like I'll bring the like my income ratios and stuff won't look good, right? So then I would do a separate trust agreement that's not registered anywhere, and there you have to have an element of trust to do an agreement like this, because they could technically sell and then you have to chase them, but you have that agreement that you can. Is that correct, Michael? like if they were to sell, if you have a trust agreement with your JV partner and they were to sell, it's not registered, so you still have to go after them, or can, is that correct?
Yes. Trust agreements are never registered anywhere for the most part.
Right.
And yeah, there is a bit of a risk if you can register a caveat on title,
Oh, yeah, that's it, yeah.
right? Which is a legal term just for the fact that there's something that has to be cleared from the title before title can be transferred. So they decide to sell it without notifying you and looping you in. Then when the purchaser's lawyer goes to search the title, or if they've engaged a title company to do so, it's going to come back with, oh, wait a minute. There's this Tony guy that's registered something on the title that has to be cleared before we can buy it. And then he'd have to come to you and you would charge him an annoyance fee, I would assume. This will help you with your memory.
Right.
We're joint on this property, and I would definitely charge him an extra fee. But yeah, if that would make it totally secure, and you would do that after obviously the loan had been granted, so the bank wouldn't know anything about it.
Right.
I mean, there's a risk, right? Some people get the title and then transfer to the corporation after, 2-3 months after. Theoretically, the bank can go back and check. I've never heard of a case where they do. As long as the bank gets their payments on time in full, they don't really care about anything else.
Right. Right. Yeah. Does that answer your question, Philip?
Oh yes, because I'm just curious because just trying to connect all the little pieces in my head right now.
Right, right. Yeah, there's a lot of moving parts and it takes a lot of creativity, and that's why it's good finding these networks and partnering with people who can like see it the way you see it and help make it happen,
So are you guys finding that is easier now with the interest rate hike? That the prices are now coming back to reality, like they're not like exorbitant like before, like a house selling like $250,000 over asking because of the bidding war. Do you find that now the buyers are the sellers are a lot more motivated because they're staying longer on MLS? Or
Certainly, certainly.
Sweet.
Actually, so we've gone through a weird thing where all of these properties I've showed you today, we got them under contract during the bidding wars, and we're closing on them now because we always do 3-month closings. We never do, most of the time, like this one, Sussex, was a quick closing. Harrow, the second one that was the only one that was quick, but Harrow, I think he needed like a 60-day closing or something. It was a quick closing, or it was like a firm timeline, but it wasn't too long, and it was right before the interest rate hikes. So we were doing this even during the bidding wars, but now that it certainly has become a lot easier. There's a lot more deals to be had. I don't know if you can find deals like this on MLS though. I haven't tried. What have you been noticing? Have you been making offers?
no, I am more in the mortgage side. I am a mortgage agent, so that's
Oh,
why.
you gotta talk then.
Yeah.
What
so-
kind of, okay, awesome. What kind of, do you do private money and stuff?
Yeah, by brokerage, I have access to private lenders. That's why my eyes light up when you said private.
Okay, have you done any 100% financing deals?
Not as yet, to be honest. I never lied.
Yeah,
But I'm intrigued because you know what? When I'm on this forum, I get to see it from you guys, from
Right.
your perspective. So I can then go back and look at all the products that I have available. So I can speak like you, so you understand me and we're on the same page. You get what I'm saying? Like learn the language of the customers you're serving. So that's pretty much my whole objective here.
Awesome, awesome. Have you ever had somebody bring you a $260,000 purchase price on like something this far below appraised value?
Once.
Once. And did you guys use the purchase price or the appraised value for the LTV?
Well, because it was a little bit complex, because there was multiple persons involved to purchase that house.
Yeah.
So I was more in the learning phase of that. So the principal broker was the one, cheering that, taking the wheel on that one. So yeah, he actually, they wanted to put down payment, so they weren't really interested in doing that creative finance. It was more. They weren't doing it for investment. They were doing it to get
Like, yeah, there was.
to live inside the building, right? So they weren't like you thinking about, okay, how can I keep all the money in my pocket and
Yeah.
let the bank or the lender put up all the money. So this is like something new. I learned something new today, and as I said, the more I understand how you guys view and how you guys want to execute, I can be ready for you when you come to me, or I can be a part of a team. I know exactly what is asked of me before you ask. So if I know what you want before you ask, we'll be friends for a long time.
Then you know where to go, you know how to, who to
Exactly.
talk to, which lenders and stuff. Yeah, yeah. So,
Exactly. And right now is a time where you're going to know if you really are made for this business, because the purchases, give a guy a pre-approval. He's hunting. He doesn't like anything, or he can't afford that house because he has to basically got to approve him for a higher rate, which means less money.
right.
So, and the sellers still think that it's early in the year where they could get 250,000 over asking. So they're still putting up the house for a ridiculous amount. And they
Right.
realize that it's staying on MLS longer than their neighbor's house that sold, right? So that's
Four,
what's happening.
4 months ago, the neighbor's house.
Right,
So
right.
we're seeing we're getting a lot of phone calls from sellers who they're listed on MLS. They listed on MLS overpriced because they still think there's bidding wars. And then the house is not selling and they're pulling the panic switch like, why is the house not selling? And then they're telling us, oh yeah, my neighbor's house sold. And then we look and then really the neighbor's house sold before the interest rate hikes. And so we are seeing a large number of people calling us who are listed on MLS who are still unreal. There's still unrealistic sellers out there who don't understand where we're at.
Well, they don't make the connection. But when the money is cheap, the prices go crazy. When the money is at the price it is now,
Right.
then you gotta. The thing is, they don't realize is everything now is expensive. Gas is expensive. Everything is expensive. So
Right.
now, it's not like you're saving on one side and you can spend it on the other side. Everything is at the same level. Everything is high. So you gotta, yeah. So
So
that's
what
what
I'm
I do.
looking at is like what you said is like replacement cost is not going down, with the increase of everything because energy's so expensive right now, that impacts the prices plus inflation. So replacement costs are not going down. The demand, we haven't built enough homes for the last 20 years. There's been more demand than supply. So the
Right.
demand's there, the replacement cost is not going down. So even though we're seeing a slowdown, I'm still really confident that it can't actually drop. Like it can't. I hear people thinking they're going to buy a house for 40 cents on the dollar if they just wait. But I don't think we're, who knows? I don't have a crystal ball, but I'm quite confident that as long as we have cash flow to hold on for the next couple of years, everything's going to be fine.
True.
Yeah. Yeah. So, Michael, so that's the last deal I had on the presentation that I talked about the other day. I'm just going to leave it off for now because there might be some complications with that one and I don't want to, but it's on the slides. So I've kind of come to the bottom of these deals and stuff. And so, I know it's been short. It hasn't, how long do these things normally run?
No, this is about how they run, so it's not short at all.
Okay, good.
I have a
Yeah.
couple of questions for you.
Yep.
You mentioned you got an extra 100,000 from the lender for the Harrow property. Could you just go over how that came to be?
Right. So if I
'Cause I
scroll
certainly did get an extra 100 from my bank.
right,
I
again,
closed.
Right, so again, through a mortgage broker who has access to private individuals, like he's not getting the money from a MIC or anything like that. So there's not an institution. They use the appraised value and they don't use the purchase price, but there's a lot of factors there. I have over 20 years of experience in the field of construction and renovations. They know what my strategy is with this property. We have a relationship. We also have a really good credit score, up in the 800s, right? So all of those factors together, he takes that, he goes to his private guys, and it's all done based on the appraised value, not our purchase price. So I do actually have a question. I haven't even run the numbers. I don't even know what LTV that is. So if the appraised value is 410 minus 360, that's 50,000 of equity divided by 410. Wow, they went basically up to 90%, I think, pretty close to 90%. A little bit
Yeah,
up.
just under 90%.
Wow. So you got, there's a couple things happening there. We got somebody that's willing to go high loan to value. They trust our background and what we're doing and all that stuff. And they're going, mortgage brokers going to private guys, people, not like institutions or anything.
Yeah, and I think you answered my second question, but just to make it obvious, seems like you're getting that private money through a mortgage broker. Is that
Yeah.
correct?
Correct.
All right, that's what I had. So Philip and
Yeah.
she, go ahead, ask your questions.
Did you request more than the purchase price, or that was just or you try to get the financing and the rehab money all in one? That was a play that you had in mind?
Part of it was that we plan to build, so we're in phase one, and in phase one, we plan to paint the house and put a kitchen in the basement.
Okay.
And there's a $50,000 contractor's quote that I have for putting a kitchen in the basement, a new laundry in the basement, repainting the whole house. So part of that $100,000 they gave us extra was for covering the $50,000 of construction that I have a quote for, and legal fees, land transfer tax, and all that stuff. So
Okay. So let me ask you, you said that your overall reno budget was, I think, what, 350 or 300 at the end?
right. So I'm just gonna preface this. When we ran those numbers, the ones I showed you here,
Yeah.
I didn't realize, I just had, since I ran I ran this before we even took possession of the property, but I have 300 on here, but that's when we thought we were building a smaller coach house. But it turns out that we found out we can build way bigger. We can build a 1,200 square foot coach house, which is the equivalent of a new house, a whole house on the property. So this, if we go build the big one, 1,200 square feet, this number will be closer to 450. But let's just use this numbers for conversation purpose, because it's here, 300,000.
Yeah. So I have a feeling you're probably going to get the first stage first, do the reno for the 100, then you get it reappraised, and then go back to your JV or go back to your lender for that money to build.
Right.
What I like that.
Right, so I'm actually in the process of getting the appraisal, the permits, and the building quote for this building of this. You can kind of see it here, turning this into a coach house. Once I have that, and if the appraisal does say 1.1 million, like my lenders will accept an appraisal based on cap rates, even though it's a residential property. So if based on cap rates, I can get an appraisal of 1.1, 1.2 million, they'll give me 100% financing for this 300,000.
Oh, sweet. I hope that works out for you, my friend.
Yeah. That's, yeah. But it's
So
not,
I realize you're staying out of the GTA because the margin is much better outside of the GTA, I'm assuming.
right, so the purchase price is in the GTA. I mean, there is some areas in Hamilton and stuff like that. But when you're buying, over $1 million, like I'm not buying to flip, I'm buying to build cash flow. And my idea is to refinance everything commercially. Cause you can, I don't know, do you do any commercial financing? On
Me
the,
personally, not yet. But as I said, I'm trying to get myself rooted into the real estate investment. So,
Right.
and being their source of getting creative finance. So,
right,
in the near future, I'll be all over the place in terms of guys like you and also commercial as well. So, that's a pivot.
okay, so a lot of people think you need a lot of like a big building, a commercially zoned building. To refinance commercially, but I know somebody who just refinanced a single family home, one door. Under commercial financing, so you can do it. There is people that will do it. And my end goal and my end strategy to all these deals is build as much cash flow in them as possible and refinance them commercially. But to answer your question, when you're buying in the GTA, like the purchase price is so high that you're not going to be able to cash flow. No matter how many suites you have, you're going to be losing money every month, cash flowing.
Yeah, I actually looked at that specific point, Tony, because I've been telling people, if you don't already own it, don't bother trying to make a property in Toronto or the GTA cash flow,
Right.
even a multi-unit property. And I started running numbers. I
Yeah.
got a deal from a real estate agent, and I did it just more or less for practice and fun. And it was, it's negative cash flow. It's negative return on cash.
Right.
You cannot make it work under the current pricing. It's not possible. Now, if you have a pre-construction condo that you bought 3 years ago, or 4 years ago, because it was delayed, that might be able to work. But if you're just walking in the door today, not a chance.
Right. And the rents aren't even that much higher in the GTA.
That is the key. That is the key. The rents, while if you ask renters will say are high, they're nowhere near as high or haven't increased as much as the property values have. And that's simply, I would say, because of rent control, right? If you can only put your rent up, I think next year it's a whopping 1.5%, and that's a good rate, right?
Right.
Meanwhile, my property, when I bought it, and it's actually just north of the city, a condo, it went up 25% in 2 years in value.
Yeah.
And if I was renting it out at the time, which I wasn't, I've been lucky to put the rent up 3%.
Yeah.
So,
Yeah, it makes refinancing hard. It makes everything hard, but like the rents are basically the same out in Brantford. The rents are basically the same as they are in not all of like obviously the closer you get to like downtown, it's a whole different level. It is a bit higher than the other areas, but like Mississauga, Brampton, all those other areas, those rents are not far off from like Brantford or even Harrow. Like a 1 bedroom is 1,600 no matter where you are for a nice brand new. So when your purchase price is way lower, I mean, you can cash flow all day long, really.
yeah, the rent to purchase price ratio is much higher in those outlying areas. And you're right. It's not like the rents are half of what they are in the GTA.
Right. And I mean, and to touch on what you said, like you said, if you already own it, I mean, everything cash flows, but it's just a matter of how much are you putting down. You can make anything in the GTA cash flow if you put, $3 million down or whatever.
That's what the kids call cheating.
Yeah.
Because people have told me all the cash flows, and I'm looking for a 20% down payment, and they put 50% down. I said, well, you're just pretending it cash flows.
Right.
So
Right.
yeah,
And then the more money you have, like if you have 50% loan to value, it's a safe position to be in. And you might, depending on where you're at in life, you might want to do that. But if you want higher return on investment, you want the least amount of your money into the property. And that only works in these out areas outside of the GTA.
Yeah, if for no other reason, you could pick up 2 houses with a 250 down payment versus 1 property with a $500,000 down payment, right?
Because it's the dirt, it's the land that it sits on that's really making the real appreciation and the money. Yeah, absolutely. Yeah. Anybody else have any questions or?
I don't.
Okay.
Learn a lot. So,
Yeah.
your cap rate, right? How do you go about what's your what would you consider a safe cap rate for you? Like, what's your aim when you're looking for like your properties when you're running your numbers?
I don't buy on a cap rate, right? I'm buying, that's why this strategy is so powerful, because I'm buying based on residential pricing, like comps in the area. So I would never buy properties on a cap rate in Canada because they're so ridiculously compressed. But that's why when I'm selling, I'm looking at what cap rate can I sell it at. So it's all about what's that cap rate down the road. And like on this property, I haven't had it done, I haven't had the appraisal, the commercial appraisal for afterwards done on this one, but on Brantford, she said cap rates are 3.74 and in the 4.4s in this area. So I'm just conservatively running the after renovation value cap rate at 5.5 when I'm running the numbers.
Okay.
Did that answer your question? Because you were talking about when I'm buying, is that right?
Yeah, well, I think I got it mixed up because as you said, you gotta, because your strategy first is to put the least amount out of your pocket. So that means you need it to be way below appraised value. So your lender will basically put up all the money for you. So
Right.
less risk for you. And then at the end, after you finish doing all your rehab, then you consider the cap rate.
Correct. When we're going to sell, yeah, that's right.
Okay.
But if we were buying multifamily buildings, we'd be looking at cap rates and stuff, but I don't really see, I never look at multifamily in Canada, the big ones, and think, oh, what a great deal. It's always like trying to make the numbers work, so.
Well, in all of your example, you said the top floor, the main level, and the basement. So it's the 3-story houses you normally target, or just whatever deal you try to make it work?
We have to try to make whatever deal work, but generally always a house that I can put at least one extra unit in the house. Like sometimes it's not in the basement, sometimes it's like the main floor, you can make a separate in-law suite. But prefer ones with basements so that we can make the extra units. Yeah, like
Cool. Makes sense.
I got a question for you actually. So
Tell me.
when somebody wants to refinance, or when they bring you a deal and the suite in that home, let's say it's done without permits or it's not legal, how do you, from the lenders, do you just look at the appraisal and whatever it says on the appraisal, or does it matter from?
Well, okay, so it in 2 ways. No, in the qualifying, normally we look at the appraised value, and also we look at the income that is generating. Now, if it's let's say, for example, you and your income is not too strong, or we can say, okay, to be comfortable for the lender to be comfortable giving you this money, he needs income of X amount, but you only have Y, which is, say, the difference is $100,000 difference. For example, this is just random numbers I'm pulling out of the sky. Now, if you show that your rental income can supplement, some lenders will do 100%, some lenders will do 80%. Now, with the legality of it, now some lenders might be tight on it and want everything to be on paper because they don't, the lawyers might refuse the deal because it's not registered. So at any point in time, the city can come and say, no, you cannot rent it out. So now they just qualify you on numbers that it's iffy, if you understand what I mean.
Yeah.
And then you have some lenders will just lend pure on the equity of the property. It's up to you to make it work.
Right.
You know what I'm saying? Like
Right.
for your previous deals where they say, okay, we don't care about your income, we don't care about your credit score, we don't care about, but you got to pay on the interest rate part of it, and it's interest only. Or and then some lenders, how creative you are, they will actually prepay the first year for you. Right? So that you can look into that too. But it also is going to be an interest only.
Yeah, yeah. Well,
So
I like interest only. It's fine. If it gives you more options, if it gives you like, because I believe in the market's appreciating enough, and like I'm happy to pay interest only because there's always better terms.
I always tell people, look at it this way: you're comfortable to walk with a credit card at 19%.
Yeah.
And if you do a cash advance on it, that's 24%, almost 25%.
Right.
And you have some people that will go into a payday loan that is, I could be wrong, but I know it's almost 300% APR.
Wow.
Yeah, those
So,
should be illegal.
Yeah.
like, no, like seriously. And they have to put it up in the store. And
Right.
people are there. So I will say, like, don't be complaining about interest rate because you have multiple credit cards at 19%. And if you miss 2 minimum payment, that jumps to 24%. Are you okay with that? The only difference is the amount that you're being given is far less.
Right.
So you feel comfortable, but you're spending on dumb stuff that's not generating money. So, you know, you got to look at, I look at it. I always tell people, even me personally, my endeavors, as I like, I don't really, I care about the interest rate, but that's just the amount of money the bank's going to make off me.
Yeah.
But the $1 million question is, can you service this debt?
Right. So let me
That's
ask
the $1 million question.
let me ask you this. If I came to you with a house like this,
Yeah.
that has 5 suites, 3 of them are totally legal, like
Yes.
it's zoned for 3 units, but 2 of these units, we have everything except the stove. So without a stove, it's a legal in-law suite, and we have a lease for that unit, okay? So the city can't tell us to, like, if we can get it leased with just a hot plate and a toaster oven, and that's legal, does your banking look at it the same way, or do they look at the zoning and they say, oh no, there's only 3 units allowed and you have these 2 flex units? Like, you know, what's your take on that?
Okay, so let's go down the so from my from what I've seen. So I have your number. So if this is something you really want an answer for, and I need to go do the actual research with all the paperwork that you can provide for me, I'm happy to do that for you.
Okay.
But how I would say it is, yeah, depends on the bank. Like your A lender,
Yeah.
they're a lot more strict with requirements, and they go through with a fine-tooth comb. Your B lenders is a little bit relaxed, right? The best person with that don't care is your private lender, because he's trying to make money on the interest rate, right?
Right.
And he's trying to, and you know, depends on how, it's interest only. And as long as he knows that he can resell the property and he can make back his money plus profit, he doesn't care. Now, again, for the A lenders, depends, they will only go, some go 75% of your rental income, because you're going to use everything to qualify.
Right.
Some will entertain a cross collateral. So, but that's not in your case. That's the property itself. They will always try to find, they're going to review the legality of it. So they will only count the ones that the city permits you to rent.
Right. Okay,
So
But-
unless you can get your lawyer to the way he writes the document, or the
right,
appraisal, or the zoning, or what's on title,
right.
then they would use it. But most A lenders like TD and stuff will do like, well, they're changing their stuff every day. So last time I checked, it was like what,
That makes sense. That makes sense.
75, right? Your B lenders now will, yeah.
So if, well, one last question. So I have this on private money at 10%, and my mortgage broker wants me to own it for a year with this 10% money before we can refinance it with him. So my question is do your B lender, he's telling me B lenders, oh, they require you own it for a year. Is that true? Could I I've owned this thing for 4 months and I'm generating this income. Can I get a refinance with a B lender?
Well, it all depends on the legal documents you sign with your private lender.
It's
Because
it's not closed anymore. There's no, it's open now.
it's open.
Yeah,
Yeah, I don't see. As I said, I'm not off the top of my head. I don't think there should be a problem. I
Okay.
don't want to say he's correct, but I mean, if you're not what should I say now? If your legal document that you sign with a private lender don't stipulate that you can't refinance or sell before the end of the term, which is
Right.
where it can be 3, 6, a year, 2 years, interest only payments.
Right.
That private lender is the first mortgage on that property.
Yes.
Is in
Yeah.
is in first
One
position.
mortgage, one private lender.
Okay, so I mean, once you're not, stipulated legally to do it, not seeing a reason why you cannot refinance. But the problem probably, well, in a year, of course, you give it a lot more time to appreciate, so you will get.
Right.
No, I see why you probably don't. You probably want you to keep it for a year. Is to have a year worth of leases, like you can show income coming in, like because you do it before, it's going to be mid lease, right?
Right.
So you have the longer you have established income under your belt with that, the
And-
bank can use it as more predictive income rather
Right.
than you just refi, because they're going to see that okay, you just 3 months in and then you want to refinance. They're going to like raise a lot of eyebrows, like why you want to refinance so fast. You know what I mean?
Right. Okay, I get it.
Yeah. So
And when we go to a B lender, are they gonna look for, so we're gonna have leases? What if I wanna be month to month? What if I don't wanna lease with these people? Can they, do you have to have leases in place?
well, you got to show that you guarantee that income coming in. You know what I'm saying? Like, how are you going to prove that your building is cash flowing like that? Like how?
Right.
If because I mean that's why most buildings want you to sign a year lease. Because if you break the lease, you still got to pay the difference up front. So at the end of it, that's predictive income, and most of these lenders want to see predictive income.
Got
From
you.
my experience.
And do they wanna see bank accounts backing up the leases and bank statements or?
Well, you gotta. Well, basically, most banks wanna, yeah, you gotta show like some form of like hard proof, like because then nobody can fudge the numbers.
Right,
Like how you how you prove that you're collecting $1,600 a month.
right,
Yeah, because you're gonna refinance at 1 point something mil, right? So they're going to qualify you.
right.
They have to qualify you that yeah, you were, because what you going for? You're going for 100% refinance? Are you going for like, what you doing? You're going like 80, 90, 75%? Like it all depends on what you're going for. And
Yeah,
and then and also what you qualify as well. And the numbers gotta add. So they're going to look on your TDS, your GDS,
so,
and all of that.
is there options that only look at the deal that don't look at TDS, GDS and all that on the residential side, like B lenders? Or do I have to go to commercial lending for that?
Commercial lending, I'm still learning on that, so I can't really speak definitively or with a little bit of confidence on that. I'm not gonna lie to you. I try to be as transparent as possible. But the more you move away from TDS, GDS, and stress tests and all of that, you're going into deep waters of lending, private lending. Because
Right.
most institution that's on the A side wants to see that.
Right. Right.
But if you are established, there's two different types of A lender. You got A lenders for the average Joe, and then you got A lenders for guys moving money, where you can get, you get to go around the back and drink a different type of coffee. You get what I'm saying?
Yeah. Got you.
Where you have somebody definitely assigned to you, but your network gotta be of a certain level, where they will pre-approve you, where they won't have a limit on you.
Right. And what about on the B side? B lending.
Again, I have your number. Let me.
Yeah. Let's talk.
Like I'm saying, like if you're seriously looking to refinance,
Right.
I will dedicate the time and the resource and the personnel around it to give you. You tell me what you want.
Right.
I will ask you for the required documents,
Mhm.
and I will take it to the best of the best, and then we will find that solution or close to what you want.
Awesome.
And then we go from there. Just to confirm, I think I wrote down your number here.
Yeah, I put it in the chat right in the very beginning, so just it's 778-966.
Oh, it's 778-966-1285.
Yeah, or Tony at TonyMarinov.com.
Yes. So so if you're interested for a second pair of eyes on the deal, I'm happy to do that for you, my friend.
Yeah, for sure. Thank you. Certainly I'll reach out after tonight, and we should talk. Yeah.
Just let me know, man.
Cool. Appreciate it. Does anybody else have what's that?
No. Afterwards. We'll talk afterwards.
Yeah, for sure. Does anybody else have any questions or anything I guess there's only a few of us left now.
Yeah, I think that's it, Tony. So we can just wrap it up at this point.
Yeah. Awesome.
So
Thank
I
you.
want to thank you for coming out and speaking to us tonight. I know you're very busy to the point where when we were talking about this call, you actually had to stop to take a text or a call from one of your associates closing a deal. So
Right.
you're a busy man.
Yes, sir. As soon as we hang up here, I've got to make another call on another deal that we just raised capital on. So busy.
All right.
But thank you for having me, and I really appreciate the opportunity. And it was great meeting everybody.
All right. So
Pleasure is ours, my friend.
Yeah.
all right. With that, we'll wrap up and we'll see everybody hopefully in about a month. Bye, everybody.
See you
Bye.
guys. Ciao.